Welcome back to another episode of Palisade Radio. I am your host, Karema Mutlu, and on today's show, we welcome Mark Magarian, who is the Vice President and Portfolio Manager at Wells Fargo. Welcome to the show, Mark.
Thank you for having me.
Let's begin by talking about your background and how you began your career within the markets. Had you always been interested in finance from a young age, and how did you end up analysing the precious metal sector, Mark?
Well, that's interesting because when I was about, I think I was around 9 years old, and it was 1987. So it was the year of the infamous crash. And I remember that day, my father being very distressed. My father was a chef. He cooked food for people, and he was a great chef, a Michelin star master chef, but he wasn't an expert in, the stock market or anything. He handed that over to another company to handle it. But, the stock market crash really, really hit his pension plan, his savings plan he had set up. And he was very unhappy about it. And I really keyed off this distress that day. And I was like, what's wrong? What's the deal? And he tried to explain it, and I didn't really understand. And I saw on that next day on the front cover of what was I believe, the Daily Telegraph, the British paper. And it's, whenever there's a bad day in the market, or, they always have that picture of the traders looking up at the screen, looking distressed and, looking worried. And they always have that picture of the line going down and something crashes X amount of points. Well, I remember the front page of the paper. That's exactly what it was. And, I was like, oh dear, everyone lost. And, my father was glued to the TV listening to how terrible it all was. And then in the corner of the paper, in the bottom little section, there was a tiny little piece about a group of traders who'd made a fortune that very day, who'd made all this money. And I was like, hang on a second, if you'd read the press and you listened to TV and listened to my father, you'd think that everyone, it was a bad day for everyone. But apparently it wasn't. Apparently some clever chaps had figured it out and then got short and got positioned for this event and had actually profited from this situation. And it was then where a seed was really sown in my mind that, there are winners and losers in this. And there are different positions you can take where, there are opportunities even in bad situations. And I think that really keyed into me having a natural tendency to being a contrarian investor. So that's really where the seed was sown. But what really kind of took me to the next level was when I was a teenager. I met a trader, and he asked me to read the book Market Wizards, which interviews many traders back in the sort of 70s and 80s. And what was fascinating about that book was there were so many different types of personalities, different types of individuals of different academic backgrounds, all employing almost completely different strategies. Some 100% technical, some fundamental, just very, very varied, but yet they were all extremely successful. And they all seemed to have followed a very similar path. They'd all had these different trials of, where they'd been challenged. They'd had setbacks and they'd come back, and you realize that there was one thing which was connecting all these individuals, and it was perseverance, the willingness to learn, and the ability to take defeat and come out the other end in better shape than they started. So that's really where I was like, okay, I think I want to go and become a trader, which is what I went and did.
Okay, well, you've spent over 20 years as a trader and investor, and it'd be interesting to talk about how the markets have changed throughout your career. Has the way you look for opportunities changed, and what lessons have you learned from a bull and a bear market cycle, especially within the commodity sector?
Well, let me just tell you where I started in the business. So in the late 90s, I got a job as a junior trader at Donaldson, Lufkin and Jenrette, DLJ, which later got acquired by Credit Suisse First Boston. And I was trading the emerging markets at that time. And so emerging markets back then was Eastern Europe and Russia primarily, with a little bit of India. And a lot of the companies which were listed, because at the time there weren't that many, were resource plays. So, the Russian oil companies back then were trading at huge discounts because of we'd had the emerging market crisis of late 90s. Russia, had a default recently. But there were companies like, Lukoil and Gazprom, and they were trading at, low single digit PEs, very low, three times, that kind of number. And it was a really, really interesting time to take a look at businesses with hard assets and with real cash flows and, coming out of a situation where there was extreme hate and finding opportunity. And so that's where I started, and that's what really sort of perked my ears up. And, as soon as I moved out of that desk and I got into risk arbitrage, which is focusing more on M&A, it was right at the top of the market in 2000. So, I'd come out of one distressed market, and now I was about to enter another one. So there was a series of events were coming to me where it was better to be either a bear or certainly be willing to pick up to put out fires and pick up some of the fallen angels out there to try and find opportunity. And of course, lo and behold, what was in the absolute dumpster as the tech crash was coming was gold. Gold and silver had been in an epic bear market for a long time. And, when I started in this business, you have to, if you don't know anything, but you just have this idea, there's something you want to do and you want to learn, the best tool you had is history. Okay. So I would, look back at different periods of history, whether it be the 70s or the 30s or 20s, basically different super cycles in different asset classes to try and get an idea for what kind of bull and bear markets occur in different economic cycles. And, what could we expect here? And it did become fairly clear that, gold was in particular a very beaten down asset, that it was, there was opportunity, and that we had just hit a peak of a cycle, where monetary policy was about to take a new direction, where, we began at that period, the area that the central banks decided to basically start getting ever more extreme. And that really led into different situations in history where, hard assets would outperform, in particular, precious metals. So that's kind of where I got my nose into it. But I didn't really know much back then. I didn't buy the best gold and silver companies. There was a lot of trial and error. I was very technical in my trading, which helped as a risk management tool, but it didn't help me find the best opportunities. My fundamental analysis skills kind of came later on as I learned.
Very good. Okay, well, let's talk about the precious metal sector today. It is easy to become excited over the recent moves for gold and some specific miners that have started to outperform. So where are we in the bull market for gold today, Mark? How do you see the market?
Well, we've been in a, depending on your perspective, it depends on how far you pull back the lens, right? We're either still in the bull market from 2000, and this was just a very long pause, or we've just had a 5 or 6 year bear market and we're about to start a new bull market. So I'm probably leaning towards the latter, that this is a new move and it should be considered in its own isolation. And it's very, very early. This is extremely early. I did a poll about, 6 to 9 months ago, approximately. And I asked someone, said, hey, so if 10 years ago, I'd have told you that central banks sort of created 15 trillion plus out of thin air on a keyboard, bought a bunch of stocks, bonds, and anything else they could have got their hands on. Interest rates in half the world were negative. Government debts were completely out of control. If I told you all these different things, and that's just a handful, right, of examples, where would you think the gold price should be? Most people came back with between $5,000 and $10,000 an ounce, because some of the things which have gone on, have been going on for some time, but yet the precious metals market has not acted perhaps as you would have expected during this time. And I think that's the nature of markets in general. And it's certainly a case now where we are seeing a clear rebirth, should we say, of this market, and I feel that there's a lot of pent up demand and revaluation that needs to occur in this sector. So, we are very, very early. If the average bull market has, let's say, three or four different waves within it, let's say, which can last, 3, 5, 6, 7 years at a time, we are wave one, and we're probably halfway up of that wave. We basically haven't had a pullback in gold until this last week. And that's a pretty small one, all things considered. We've gone from, mid 1500s back to 1500. And, to my opinion, that most gold mining companies, particularly the small and medium ones, are not priced for even this price of gold and silver, let alone what could potentially happen down the line. So we're very early, and there've already been some big gains in some stocks, but many haven't really moved yet. And I'm being very patient. I've been positioned for this for some time. I've been a bit early, but I'm certainly not going to be giving anything away too soon while the mainstream haven't really begun to touch it yet, and fund institutions are only just starting to dip their toe back in, from what I can see.
So apart from the precious metals, are there any other commodities that look bullish to you, Mark? Or are we in such a financial mess with inverted yield curves, interest rate cuts, and a possible recession within the US? Are gold and silver the only assets that are going to outperform going forward?
Copper, you can pretty much rationally prove that there is not enough copper coming out the ground in the long run right now to sustain demand. Okay? You can prove that within a reasonable, margin of error. However, the timing of when that balance really, really flips into, a strong copper bull market, I feel has already tripped a few people up. I can see the temptation. There are some cheap copper assets out there. As I said, it reminds me of some of the gold and silver stocks in 2015. But things can get worse. And with where we are in the economic cycle right now, with a recession coming and all that, as you said, there's a very good chance of that. It feels that now might be a good time to be patient on that area. So do I like copper, for instance? Yes. Do I think that things are going to get worse with where we are in the economic cycle? Probably, in which case we might be looking at a much better entry point for that asset. Now, I can also touch on uranium. Uranium's interesting because unlike other commodities, you can pretty much add up the majority of the uranium supply on one page. You can pretty much lock down, 90% of where it all comes from, a handful of countries and a handful of companies. It's not that hard to figure out that supply demand equation. The issue with that obviously was the inventory build, which was created because of the Japanese Fukushima disaster, and that's still working off. Now, it seems to me that the uranium companies are acting more economically sensitive than some sort of defensive play like gold and silver. So, as per my copper comments, that is another area where there does seem to be a handful of pretty interesting companies out there, but they're probably going to get cheaper. And that's the biggest lesson I've learned from becoming a gold and silver investor, is when something's trading at, 3 times cash flow, 3 times free cash flow, and you think, my God, this is so cheap. In the real world, I would go buy this company today. Well, guess what? It can go to 2 times, and now you're down 30%, or it can go to 1.5 times, now you're down 50%. And completely irrational. So I have to bear that in mind. And some of these other areas, it feels like they're probably going to get worse before they get better. And I'd probably throw oil into the equation on that as well. But I am interested in all those spaces, and there's certainly a lot of opportunity. And and maybe I'm wrong about where the economic cycle is now, but I'm currently operating under the proviso that there's worse economic events to come over the next 18 months. And so hence it's probably wise to be a little bit more prudent on that side of the ledger and stick with the precious metals plays which are working right now. They are clearly in a new bull market. We're breaking new highs. You're seeing everything you want to see that should make you feel comfortable to hold those positions, while some of those other commodities we just touched on are doing the opposite. So I'm being patient on that.
As we begin to wrap up, Mark, it'd be good to talk about how psychology has played a role when positioning yourself within a market. Once you're positioned in a market, how difficult is it for you to be right and sit tight, especially if other markets are still making big gains? Sometimes doing nothing is the hardest thing to do. What are your thoughts?
Yeah, I think that, anyone who sort of shows up with no experience in this good business and tells you they're amazing, they're lying. Run away as fast as you can. You have to have lived through enough cycles and made enough mistakes to develop that wisdom to see not just the psychology of the market externally, but also to understand your own psychology and your own ecosystem, and how that reacts to different situations. And if one of the biggest things I've been guilty on in the past is being early, but not often wrong. If I've done my homework, if I've done my field due diligence, being wrong over the long run hasn't always been an issue, but being a little early has been painful at times. And certainly that's something I'm striving to continue to improve on. But right now, I think psychologically, I try and stick to, I try and put into writing what it is that we're trying to achieve, what a typical cycle looks like, and where we are valuation wise within that cycle. And then that enables me to sit tight. Do you see what I mean? When we've come from crazy cheap to just regular cheap, but the stock's up 100%, yeah, the temptation is to take a little bit off the table, and that's the case in a couple of different situations which we have. But the fact is it's not even fair value, let alone expensive yet. And the cycle is, as we touched on, this is very, very early, and the psychology more broadly in terms of the public has not shifted to this sector fully yet, not even close. I think in 2011. I'm going to approximate here, but I think that the average portfolio got up to about 6 or 7% in precious metals, and we're not even at 1 right now. So, psychologically speaking, I think there's a lot more to run, and I think the biggest challenge will be that when the time comes to perhaps rotate and be a little bit more defensive in this area, things are going to look really, really good when that time comes. And I'm probably going to be feeling overjoyed about it all. And that is going to be the time that I'll pick up that piece of paper to remind myself that, hey, Mark, when you're feeling that way, it's probably time to take half off the table and, read one of those old war stories you wrote down about situations like that where maybe, when everyone's loving it and you're feeling that good, that's probably the time that you need to look for some other opportunities which might be passing you by without you even realizing it.
Yeah, some great insights there. Okay, as we begin to finish, is there anything else you'd like to share with our listeners today, Mark?
Well, I would say that to anyone who is coming in afresh to the precious metal space in particular, because I feel that's very, very relevant right now, aside from the broad materials area, which is historically cheap. We both know that, is that this is just such a great time to do a little bit of your own homework and see where we are in terms of the broad valuations of stocks, see where we are in terms of fixed income and the after inflation returns that some of these bonds are giving you, and take a hard look at where monetary policy as far as central banks is going and is likely to go, and make a rational decision as to, that it may well be in your interest to have something allocated to this space as opposed to nothing. It may well be an extremely prudent decision that gives your portfolio the protection it needs during most likely some pretty volatile times coming up.
Very good. Okay, many thanks for your time today, Mark. It's been a pleasure having you on the show.
Thank you so much.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?